Good day, grade 12 learners. Today we're going to deal with balance sheet question. Today we're going to treat trial paper 2022 Mpumalanga province. Okay, there's a question of balance sheet. Question 1.1, it's return income, 11 marks, and the balance sheet, which is 27 marks. All in all, that will be 38 marks. A lot of marks. A lot of marks. Proper. Then, okay, let's quickly do the return income note as it was required and take the 11 marks as we go. Okay, this is the information given. This is the information given. We're going to prepare the note for return income. Okay, now very much important to know our year end 28 February 2022 return income that is given here on the list of balances. It is the 1st March 2021, which is the beginning of the year. Then now this is the balance of 57,480. Then that's the opening balance because of they said is the 1st March 2021. Okay, now I'll go to my return income note formula sheet. Then now I'll put my balance here. How much is this? How much is this? 57,480. Then I'll say 57,480. 57,480. Then now quickly I need net profit after tax. Then I'll go to the information given and check what can I use to get the income tax after tax. I'm king the net profit after tax. Net profit after tax. So now, okay, let's see the information. Oh, information is they talk about the profit and the tax. You see. Then now there is an information that said income tax at 31% of the net profit for the year amounted to 306,280. So now, meaning this amount is for income tax. So this amount is for income tax. This amount is for income tax, meaning it is being represented by 31%. Then now we are looking for what? We are looking for net profit after tax. That would be the difference between the 100% minus the income tax. That would be you're gonna say 100 minus 31. That would be 69. Proper. So now you are looking for 69 and you are using 31. So it's gonna be 69 over 31. Then times the income tax amount. Then that will be 306,280. So now this is what will happen here. This is what will happen here. To get this, you will say the 69 divided by 31 times, is it times what? Times 306 to 80. 306 to 80. Then we will multiply now. Let's multiply. And 69 divided by 31 times 306 to 80. No. 69 divided by 31 times 306 to 80. Yes. Wait. Why are we getting a cover here? Oh, 280. Oh, it's 280. I'll correct that. It's 69 divided by 31 times was what amount is that? 306 to 80. 306 to 80. 306 280. So it's 681 720. 681 621 720. Then it's proper. Then this is 8. Okay, proper. Then now, let's quickly go and check how we can go with this. Then now we need the repurchases. So we need repurchases. Information about the repurchases is here. They saying on the 28th February 2022, the company purchased 40,000. Repurchases 40,000 shares at 1 rand 25 above the average. Uh, Average price is 6 rand. 6 rand. So now, when they say we purchased above the average buy, so now this is the difference between the average price and the real price. So meaning we retained 1 rand 25. We wanted the above. We use the above average price, on the retained income always. So that's the difference between the the purchasing price or the real price minus the average price. So that is the amount that you're going to retain, which is 1 rand 25. So we'll quickly come here and say, okay, we repurchased 40,000 shares times 1 rand 25. Then how much are you going to get? Then that will be 40,000 times 1 rand 25. Then we're getting 50,000. Then now, we'll need the dividend, ordinary dividends, interim and the final. Let's come there and check how we'll do. Okay, we're given the final here. Final dividend is 210,000. Let's just put it here. It's 200,000. We don't need to calculate it. Then we are just given. So now, okay, fine. We go to the interim. They said interim dividends is 28 cents per share. Was paid on the 30th August 2021. You see, now we paid interim before repurchases came. So it means repurchases, they do qualify for interim. These shares that were repurchased by the company were 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 there were there were there at the beginning of the year. So it means they qualified for a dividend. So now it means we will take the shares at the beginning. Shares at the beginning, they said, is 80% of the authorized share capital. So now let's say authorized shares capital, authorized shares is 800,000. They said 80% were in issue. So we issued 80% of these. So now we will say times 80%, then we'll get 640,000. So now Uh, these 640,000 are those shares that they qualify for dividend. They have been there until the date where we pay dividends. So now we'll multiply by what? Multiply by 28 cents. 28 divided by 100. Then that will be 179 200. 179 200 will come here. Then, okay, then from there, the dividends you subtract. Then from there, you can get the final amount there. You're done. 57 for 80 plus 681 720, then minus 15,000, then minus 179 200 minus 210,000, then that will be 300,000. So this 300,000 will need it in our balance sheet. When we're doing the balance sheet now, we'll need this 300,000. This balance at the end will come to will come here. Will come here. Then that will be 300,000 proper. Let's come here on the balance sheet question 27 marks. So now as As I mentioned, this is the trial paper from Mpumalanga. Uh, okay, we have in this working paper, they are given amounts that are indicated here. We are given the fixed asset at carrying value amount, no need to calculate. Then now we given the inventory, no need to calculate, and we given the trade and other payable, no need to calculate. Then we need to complete the balance sheet proper. Then okay, let's start with the fixed asset. I mean, not the fixed asset, the fixed deposit. Fixed deposit. We are given this amount from the list of balances, 415,000. So it is given here. 415,000 is given. 415,000 is given here. So we'll go to the adjustment talking about the what? The fixed deposit. Then now let's go and check the adjustment talking about the fixed deposit. Now, here is the adjustment. Here is the adjustment. Adjustment number D. Adjustment number D says 165,000 of the fixed deposit mature on the 30 June 2022. Then the rest will mature in 2025. So now this when the fixed deposit mature, it means it has reached its date for investment. So it will come to our bank account. So it means it will move from the non-current, from the long-term investment and come to the current asset, from the non-current asset to the current asset. Because we invested it for a longer period, for more than a year. So now we will need to remove it. We need to remove the matured year and bring it to the current. So now it will go to our bank. So 165,000, we need to minus it here. 165,000 minus it here. And it will go to the bank account. 1 plus 165,000. It will go to cash and cash equivalent. Now, let's see. Let's see another. Okay, that was done. That was done. Let's calculate. Let's calculate. Let's calculate. 415,000 minus 400. This is gonna be 250,000. 250,000 minus this, obviously. I need to calculate this. Okay. Now we can calculate the non-current asset total. Yeah, then that would be 3,940,000. Then plus 250,000. Then that would be 4,190. 4,190,000. Now, there's the inventory given. Then now there's a trade and other receivable. Question mark. Yes, it is a question mark here on the list of balances. It's a question mark. We don't have it. It's a question mark. We don't have it. It's not there. So it means now if it's a question mark, we don't have information about that. It means this is the balancing figure. So we need to calculate this at the end. This is gonna be a balancing figure. So we're gonna say balancing figure, right? So now this will calculate at the end once you're done. Once you're done with everything. Now let's add our cash and cash equivalent. Oh, cash and cash equivalent, is it done? Let's check if in this any other adjustment talking about the cash and cash equivalent. Yeah, there was this adjustment here. They said about the repurchases. They said full amount of the transaction was paid by EFT. Was paid by EFT. It means we paid, money goes out, ne? But they said, but the EFT was not yet being recorded in the books, in the CPJ. If it is not yet recorded in our books, it means we didn't update our bank account. So it is not recorded. So now we need to record the amount that went out from our bank account. So now it means we will need to use the real amount that we paid to the non-existing shareholder who sold his shares to the company. So now proper. Then it means now that will be the real price. It will be the price above average, which is 1 rand 25. 1 rand 25 plus what? Plus the average price. So it will be 7 rand 25. So it means the 7 rand 25. We paid 7 rand 25 to the non uh, existing shareholder times those shares, which is 290,000. So now we'll come here and say, okay, this was not recorded. A payment was not recorded of what? Of 290,000. So we need to record it. Then now, probably you're done. That will be 212, 400, then plus 165,000, then minus 290,000. Then that will be 87, 400. That will be 87, 400 proper. Then now it means you're done with the asset. You only left with the balancing figure for trade and other receivable. You'll calculate it at the end of the workings. Now let's quickly go to the shareholders equity. Shareholders equity, we're having ordinary share capital. We're having the return income note. Okay, this one was done. It's fine. This one was done. Let's check the ordinary share capital. Which information can we use to determine the share, ordinary share capital at the end? Now, we'll use this information about the share capital and the dividends, and let's check if there's another information that we can use. Yes, we can also use the financial indicators because we are having what the retained income, and yes. Now let's see. Yeah, it's possible that we can use the nav. Yeah, the nav. So let's see if we can use the nav. We'll use the two methods of calculating the value of ordinary share capital. So let's use the nav. If we use the nav, if we use the nav net asset value, this nav. What is the formula for nav? This is a financial indicator. What's the formula for nav? Shareholders equity. Shareholders equity divide by number of shares issued. Altogether. Then now from multiply by 100. So now we are given this nav. We are given this nav. Where is this nav? This nav is 650 cents. So the 650 cents is here. Then, okay, this one obviously we don't have it. The shareholders for equity, shareholders equity, we don't have it, which is the total one. Shareholders equity is the total one, ordinary share capital and the return income. Yes. So this one we don't have it. Shareholders equity. Let me just resume my paper. Oh, damn it. Shareholders equity. We don't have it. But this one we have it. Number of shares issued at the end. So we need to use the number of shares issued at the end. Then now that will be because we only have two shares on the information given. Remember, these are those shares that we issued at the beginning, and we don't have during. We only have repurchases. So in order to get the number of shares issued at the end, we'll just say issued at the beginning, which is it was 640,000 because it's 80% of what? Of 800,000. So that would be 640,000 shares. Then we need to minus what? The 40,000 for repurchases. Then we'll get the number of shares issued at the end, which is 600,000. Then from there we'll say, okay, this is the 600,000 shares here. You see? Then now, mathematically, we are looking for what? For this one. So now, mathematically, we'll just do what? cross multiple because you are having an equal sign. So now we'll cross multiple, meaning in other ways that will be shareholders equity. It will be uh, it will be 650 cents times 600,000. Then you'll get how much? Let's see. 650 cents, 650 cents again. 650 divided by 100. Then that will be 6,5. 6,5 times 600,000. Then that will be 3,900,000. So this is 3,900,000. Then what do we call this? Is the shareholder secret. Then I will come here and put it here. This is the shareholder secret. 3,900,000. So now we got the total. Now it will be this one minus this one. That will be 3 million. Just minus 300 there. That will be 600. Then the second formula that we can use because we are having an average. We are having average and we are having balance at the end. We are having issued shares at the end. So now we can just take issued shares at the end, which is 600,000 shares here, right? Then we just multiply with the average price. What was the average price? Let's check the average price. It's six rand. So it's 6 rand. So now it means now if you calculate, we take the 600,000 and multiply with the 6 rand, the average, we should get 3 million 600. Let's check. Then that would be 600,000 times 6 million 600. Correct. Proper. So two formulas are there. So either use this one or use this one. You can use this one, then you add the two, or you can use the nav to get the total. Then from there, you'll take the difference between these, you'll get the ordinary share capital. Proper. Then now let's go to the non-current liability, which is the loan. The long-term loan or mortgage loan, we given this amount from the list of balances, which is that one here, which is this 1,155,000. Then is given there. Then we'll just need to go check the information given. Let's check what is happening now. Information E, this a loan from a director J. France. Then loan was originally received on the 1st December 2019. On the 1st December 2019, this loan is to be repaid over 5 years in equal monthly installment with the effect of 31 December 2019, and all payments have been made. Interest is not capitalized and has been paid in full. So now the interest has been paid. It means there's no accrued interest. And now, if the interest is not capitalized, it means it doesn't form part of the loan. Understand? And now they just give us an information that this is paid. If it was not paid, it was going to be an accrued interest. And since it is not capitalized, it was going to be form part of the trade and other payables because it is not capitalized. But if it's not paid and it's capitalized, then it will be part of the long-term loan. Understand? So now they said it is being paid in full. So no record of the interest. You don't have to calculate interest and record it or so. You're complicating things because they said we paid the interest in full. Now, uh, what you are looking for now? What you are looking for? We are looking for the current portion of loan, short-term loan, a short-term loan, current portion of loan, the loan that will be payable within the next 12 months. So the next 12 months. So now it means this will be paid in the next 12 months. We need to remove it from the long-term loan because if we are saying we are having an amount that we're going to pay it in the next 12 months, meaning now this is going to be a current because current should be something that will be within a 12 months. Then if it's within a 12 months, then there will be a current liability. Understand? So that's one of the same thing when when we were doing the fixed deposit there that will mature, we removed the fixed deposit mature because will be resolvable within a 12 months. So we need to remove it from the non-current and put it to the what, to the current. So now we need to remove the short-term loan that will be payable within the 12 months proper. Now okay, they said to this loan was a loan for 5 years and will be paid an equal will be paid in an equal installment on a monthly basis, right? Proper. Then now this loan, let me quickly do like this. Okay, let me quickly do like this. So this loan, uh, this loan is for 5 years. So now it's for 5 years. Let's just make it simple. Just multiply by 12 so that we can get then we can use the months. So this is 60 months. This is gonna be 60 months. 5 times 12 is 60. Then proper. Then okay, this loan we took this loan on the 1st December. On the 1st December, right? And we start paying this loan when we start paying this loan effective from December, 31 December. So it means we paid December, we paid January, we paid February, because our year end is ending. Our year end is ending February. So now we started paying on the 31 December 2019. We paid 31 December. We paid the 31 December 2019. We paid 31 January 20 2020. Then we paid what? We paid 28 February 2020. So we paid this one and this one and this one. And what is our year end? Our year end is ending 28 February 2022. So now proper check. It means we paid these 3 months in the first year that is ending what? February 2020, which is 3 months. We paid 3 months this one. Then we will go and pay. After they said all other payments have been paid. So now we'll go to the next financial year, which is the 1st March 2020 until 28 February 2021. Even this one, the whole this period we paid it 12 months. We paid this 12 months. Then now we also paid what? We also paid our current year. Our current year. We paid the 1st March 2021 until the 28th February 2022. So we paid another 12 months this one. So now we paid how many months? We paid how many months? We paid how many months? So we paid let's see, 24. That's 24. 24 plus 3, that's 27. So yeah, that's 27 months. So that's 27 months. So now it means the loan that is given here, it's a loan for how many months? It's a loan for how many months? This one. It's a loan for the remaining months that we didn't pay. Because this loan was for 60 months and we paid for 27 months. So it means this loan, the loan that is given there, is a loan for how many months? It's a loan for, let's calculate, that would be, where's the calculator? That would be 60 minus 27. Then that would be 33. So it means that loan is for 33 months. 60 minus 27 months. This will be a loan that is given there is loan for 33 months. So now we can get the monthly installment. So the monthly installment will take that loan that is given there. The loan that is given there, which is 1,155,000, the 1 million 155,000. And now start to and divide by 33 months. Divide by 33 months. Okay, let's just divide by 33 months and get the monthly installment. So now we'll say 1,155,000. Then now we'll divide by 33 months, then we'll get 35,000. So this 35,000 is per month. We pay this per month. Per month we pay 35,000, 35,000, 35,000, 35,000. So now we want the loan that will be payable in the next 12 months. We want for 12 months, for the whole next year, 12 months. So now we don't want per month, we want for 12 months. Then now we'll just multiply by 12. Then that would be times 12. That would be for 20,000. For 20,000. Now, this for 20,000, that will be a current portion of loan. Then we need to minus it here and remove it from the long-term loan for 20,000. For 20,000, we remove it here. Then it will form part of the. It will be this one, form part of the current liability. Now we can calculate the balance there. That will be 1,155,000 minus 420,000. That will be 7. That will be 735,000. Now, yeah, you're done. You're done with the loan. Then terminal payable was given. The shareholders for dividends. Shareholders for dividend. Always, you should know that this is the final. This is the final dividend. This is the final. It has been declared to be paid in the next year, in the next 12 months. So now that will be interim. I'm not interim. Final. Come on. Okay. It was given. I think it was 210,000 somewhere there. I think it was here. Yeah, I can still remember 210,000. So it is given. It's 210,000 was given there also in the information. It was given. Now, how we are done now, we're only left with one. SARS income tax. SARS income tax. This amount is being given. Oh, given. This is the income tax. It was given. This is the income tax that was given on the transaction. So we need to minus what? We need to minus the provisional tax payment. So the provisional tax payment, that's a payment, provisional tax payment. It was given there on the information given. They said the SARS income tax, which is provisional tax payment is 280,000. So if you are not given the provisional tax payment, the SARS income tax, that will be that income tax that is there that you get from the income statement that was given, which is that 306,280. But there is a payment that we made here. We paid 280,000. So we need to minus this 280,000 here. Let's minus 280,000 here. Minus 280,000. So if you minus 280,000, probably this is gonna be 26. Yeah, it's 26 what? It's 26. Yeah, 26 to 8. 28 must 28. Because yeah, I think that would be that. Yeah. Yeah. We can add now. Hey, Mar, let's confirm this amount. 306 to 80 minus 280,000. Yeah, 26 to 8. Yeah. Okay. Now, let's get our current liabilities 26 to 80 plus 420,000 plus 210,000 plus 231,920. Then that will be 888,200. That will be 888 200. Then now you're done with the liabilities. All liabilities and the equities are there. Then you can calculate what the total. Let's calculate the total equity and liabilities. That would be 3 million, and on that, then that would be 735,000, and that would be 888 200, and that would be 5,523 200. Then you come here and say this is 5,523,200. Then now you'll take it here. You'll take it here because you are having a balancing figure there. So it's gonna be 5,523,200. Right? Then, because we are having a balancing figure there. So now how to get that balancing figure? So it means we this current asset is incomplete. So we are looking for this total current asset. So now we'll take the total asset that we put there, which is 5,523,200. Then we'll minus what? The non-current asset. So we're gonna say minus 4,190,000. So we'll get this 1,000,000. That will be 1,000,000 what? Where's that? 1,333,200. So that would be 1,333,200. So it's for current asset. So now, in order to get this one for the balancing figure, because this is gonna be a total for the current asset, then we're gonna say this one minus this one minus this one. Then now let's minus the inventory of 222,600 and minus 87,400. Then that will be 1,000,000 and 20 1,000,000 and 23 200. 200 or 300 200. And that is good. That is good. Proper.